But how could the fund simply prevent investors from withdrawing their own money? Don't the investors own their money, just like the people who put their money into FTX? In this case, though, it's a lot less sinister. Attorney Tre Lovell from the Lovell law firm says freezing withdrawals is part of their pre-written agreement.
They do that for a very good reason. They need to protect the integrity, the strength, and the value of the company. And if there's a mass exodus of investment, of capital coming out, it could affect adversely the company as well as the existing shareholders. So they need to have controls in place that allow them to try to honor redemption requests to the extent that such doesn't expose any risk to the company and the existing shareholders.
Blackstone told its investors that it would freeze withdrawals if they rose above 2% of its monthly net asset value. So essentially, this is perfectly in line with what's supposed to happen. So in a sense, Blackstone is simply a victim of a bad economy.
In the public square and public opinion, it's just never good if you can't, allow your investors to get their money out. Typically, when a company doesn't allow that, people get scared. They think that it's for something nefarious or something negative, when oftentimes it's not.
Lovell says Blackstone needs to educate and persuade the public that the fund is doing well and that it simply wants to protect everyone. The Blackstone Real Estate Investment Trust makes up around 17% of the entire firm's earnings. We're going to take a short break now, but if you have any news tips or feedback for the show, please email us at business@ntd.com.